The webinar will begin shortly. Please remain on the line. The webinar will begin shortly. Please remain on the line. The broadcast is now starting. All attendees are in listen-only mode.
Hello and welcome to the Morning Bell for Yellow Tunnel. I am Keith Harwood. Standard disclosures before we get started. Options involve substantial risk and are not suitable for all investors. Please remember that neither Tradespoon, Yellow Tunnel, or myself are investment advisors, not registered with the SEC or FINRA. If you do have questions about your own personal financial situation, please consult with a registered financial advisor. The information in this presentation is for education and information purposes only and should not be considered trade advice. And finally, myself or the team at Yellow Tunnel and Tradespoon may have a financial interest in the securities presented and the trade ideas. So please keep that in mind as you evaluate these trade concepts for your own personal investment and trading portfolio suitability. Good morning, everybody. Good morning, Fred. A reminder, if you guys have questions about specific stocks that you're looking at right now, throw those into that Q&A box. We will evaluate as I can. Talk you guys through some of the stuff that I'm seeing. You know, maybe it'll spark some interest in terms of a trade that, you know, might be of interest to you guys or to myself. So I'm always interested in seeing what you guys are looking at. You know, as a reminder on the disciplined trading side, there's that fight or flight response. It seems like right now the market is doing a little bit of fighting against the new high, is continuing to lead or hold the market up. There was some risk reduction. We've got a Fed decision this afternoon. Honestly, I don't expect anything bearish, but that doesn't mean that something bearish can't come out to derail this market. We're in December. I don't know that the Fed wants to say anything that could be particularly negative for the market. And they're aware, you know, they may pretend that they're not, but they're aware of how the market behavior is going and wanting to make sure that we've got stability and bullish behavior. But nonetheless, we drifted down towards the lower end of the range in SPY. We continue or have continued to see weakness out of the Dow Jones Industrial Average, out of small caps. A little bit of a bounce back today. We had a 9-day sell-off in the Dow Jones Industrial Average, which I read was the first time that happened in basically 50 years. So, you know, we've certainly had some moves that are not traditionally normal. But, you know, we know that from the seasonality, the S&P sometimes has a little bit of a dip, and then that week leading into Christmas tends to rally, and we're right there right now. So timing could be right, especially if the Fed does kind of what's expected, give some confidence back to the market, and then people turn to the Santa Claus rally, the end-of-year rally, and then start looking forward to the 2025 trades. Post-Christmas, post-New Year's Day, we start getting some allocation shifts, some rebalancing of portfolios, you know, big investment flows that need to rebalance. That means that they'll oftentimes sell the outperformers of 2024 and buy into some of the underperformers. That's the thesis behind the Dow of the Dogs philosophy, buying the weakest performing Dow Jones Industrial Average members to start the year and selling some of the strongest performers. You know, just when money has to move, the markets have to move as a result. So we'll keep that in mind, and we'll continue to evaluate some of those setups, here over the next week or two. I still believe probability of success is to the upside. With the increase in the VIX, the return on capital has reduced somewhat. It's not a high VIX, but we did approach 16% instead of that 13 or 12%. That can put some froth into some of these markets off of that hedging behavior that we've been seeing in the market. But we got to keep that in mind. That said, if we do get the normal like spike type behavior to a new high, that pays out just fine. So the fact that we dipped, we're now pricing in the possibility of that new high. Had we been coming from the highs, maybe that was a more muted potential response. Now there's a little bit more room to run. So that means the return on capital in a stock position may be a little bit higher, but the options position has somewhat neutralized that. I want to see a trend change in the Dow Jones before I get too aggressive in that sector. We are seeing a little bit of, like I said, of upside today. It's not a trend change yet. Got to see a higher high and a higher low. Maybe that comes today. Maybe it waits till tomorrow. Maybe it doesn't happen for a week or two. As it currently stands, we are not seeing that fall through weakness today, which is at least the starting point potentially of a bottoming action. But I'm not ready to call the bottom quite yet, at least not aggressively. So, we were talking about it in the closing bell yesterday. If wanting to call a bottom there, given the magnitude of the move in an index product, as long as the risk is well defined, it can work out okay. If the risk is not well defined, if the stop loss is not set firmly, it's a dangerous maneuver to say, okay, well, I was interested in buying here. If we drop another 2%, I'm even more interested in buying. That is not the right philosophy for our short-term trading strategies. For a long-term hold, maybe it can be a bit of a stronger thesis. If I'm looking to put this into a 401k and hold for 10 years, getting dips is a great opportunity to buy for a long-term investor, but getting a dip to buy for a short-term trader to make sure that I understand exactly how much I can lose and not allow myself to get married to a position when it is a short-term trade. All right. Flexibility is key. Let's keep an eye on what the rotation does after the Fed announcement. We may see flows back into small caps. We may see flows into financials. We may see it into home builders. All that is to be determined more this afternoon than leading up to the Fed decision. So I want to watch the market behavior today, but know that fundamental input can quickly shift the investment thesis for the end of the year and what's going to perform best to close out 2024. And on that note, I hope you've all had a wonderful 2024. Hopefully you've had some good performance and a good year outside of the markets as well. And here's to another great year in 2025. I know we're still 2 weeks away, but I'll say it now and I'll probably say it often over the next couple of weeks. So with that in mind, let's start with the 10-year yield. We've been drifting towards this 4.5 level. That's my biggest concern point. Inflation conversations have started to come up. Stagflation concerns have started to arise, where if we have a weak economy, strong inflation rates, increasing inflation in order to fight an economic recession, or do you raise rates to fight inflation and potentially stall it? The biggest danger that we've got is if stagflation becomes more of the commentary from the talking heads. I've seen it a couple of times now, so that starts to tell me that people are starting to talk about it. I don't want to see the 10-year yield over 4.5%, honestly. I'd like to see something that comes from the Fed. I'm not sure what their verbiage has to be to keep this Goldilocks scenario of we're between 4 and 4.5%. The economy is fine and inflation is under control. That's the optimal scenario. Inflation under control with a strong economy. The opposite of that, inflation starting to rear its ugly head while the economy is weakening. That can create damage to the stock market. So to be determined if that becomes an issue. As it currently stands, it is. And I always pull up Bitcoin on my bar chart as well. And you can see Bitcoin pulling back a little bit today. So a bit of a choppy rally right here. It's not that explosive elevator up. It is a bull market with dips. And that's okay. as long as these dips remain shallow, we're in good shape. Getting back below the 100,000 level is a very big number for the psychological element, getting back into 5 figures on the Bitcoin price. But every time we've dipped, it's ended up being more of a buying opportunity. We may get back down towards 100,000 before the next leg higher. I think concern for any trader on the Bitcoin side, especially the bulls, is what if we dip and that dip becomes liquidation as people start to look to take profits and are willing to pay that tax bill? I think most people are looking to hold through to the new year as best as they can, pay that tax bill in 2026, April 2026 instead of April of 2025. But if we start to see liquidation, then that can shift that mentality. Paying taxes now in order to capture $100,000 of Bitcoin is a heck of a lot better than paying taxes later on an $80,000 Bitcoin. The value is there. The commentary is there. The political administration has a bullish crypto mantra to it. So do I expect to see liquidation? No, but Bitcoin is kind of its own beast and crypto is kind of its own beast, where sometimes we see these irrational magnitude breaks in spite of the fundamentals behind it. So just have to be prepared for that and consider that when looking at some of these Bitcoin related stocks like, Marathon, Riot, BitDeer is the ones that I normally look at, along with, of course, MSTR, which didn't get that juicy pump up after the NASDAQ 100 inclusion that I frankly expected. Maybe it was already being priced yesterday in MSTR week. That was a little bit of a yellow to maybe even red flag in MSTR, but we got to keep watching it. There is that explosive potential. It could be a very exciting trade for the end of 2024 and into 2025. Going to the broad market. Not One Oak yet. We'll come back to One Oak type trades. S&P is fairly unchanged today. We saw some good performance yesterday with the dip getting bought back up to unchanged on the day. Today, down very small. I think that this is just that final stages of consolidating risk reduction, people positioning for the Fed. The real reaction is going to come this afternoon and into tomorrow. We'll see what they say. If we break below 600, I get concerned about a move to 585. Previous resistance that we broke through, it became support. On this dip, we did dip down towards 584, slightly below it, but effectively we're looking at that 585 level, the October 17th high, as the main support if 600 doesn't hold. If the Fed does as expected, we may initially stall out a little bit at the top, but I'm not sure that I would expect that to hold given seasonality and everything else. And, just to touch on seasonality again for the umpteenth time, for SPY, we normally see a little bit of a dip and or consolidation here from the beginning of December or second. As we approach Christmas, we get this nice rally. So from here to here is about a 10% rally, 10%? No, not 10%. Sorry, that would be from 590 back to 610. So about $20 rally in SPY. We're a little bit above it right now. We've had a little bit stronger performance overall, particularly since the election results were announced, where we popped up above the seasonality chart. Good correlation though at 88%. We're right in line with the normal expectations on the seasonality. And I got to think that has very little reason not to come through today, again, barring something crazy out of the Fed or barring something crazy out of like an Apple or Nvidia, one of these mega tech companies saying that there's a real problem in the tech market. When we look at the VIX, as mentioned, up a little bit here over the last few days. So we'll get rid of that spike from the visual here, but you can see over the last 3 trading days, we've been rallying up as people hedge their portfolio in preparation for the Fed and into the end of the year. Now we're pricing out 30 days from now is mid-January. Maybe there's some concern about what the market can do when 2025 begins if reallocation starts to reduce the market. This VIX is not high, but it's certainly elevated, and I expect that as long as the Fed does what we expect it to do, this VIX should drop back down towards 13.5% heading into Christmas. slow time of year. Often we see limited volume. If we just get that lower volume rally into the end of the year and then prepare for the big reallocation trade and the rebalancing of portfolio trade for January 2025, that's an okay thing. And we just want to see that VIX lower to generate greater potential return on capital on those new trades. And of course, SKUDEX. This is performing even stronger than the VIX, which means that the buying of the options generally is on the put side. There's two then behaviors that I'm looking at. One, people buying outright out of the money puts to hedge their portfolio, or two, people that are willing to buy this dip, doing so via defined risk, selling put credit verticals. So buying further downside, maybe selling a little bit of at the money, but the general flow is on the buy side, looking to hedge the portfolio, buying those puts. We can finally look at SKU and see if they're offsetting it a little bit. And more than anything, it looks like they're buying the put rather than selling the call. As we test these previous highs, it's very close to the level of December 5th. When SKU SKEW index gets very high like this, that can signify a market top because it's a spot where the market is generally hedging, and hedging then turns to, okay, well, now puts are too expensive relative to calls. I don't want to buy a put and finance it by selling a call. I'd rather just sell out some of my stock position. That risk reduction can lead to a dip. That dip can lead to a liquidation. We're not quite there yet, but we're towing close to it. Because as I mentioned, if we get below 600 in SPY, I think a lot of alarm bells start to go off. We're not there yet, though. So the fundamental input this afternoon, if it drives more risk off, yes, the market is generally well hedged. That doesn't mean 585 won't happen. It just means that, to me, this is not lining up to be major liquidation. It doesn't mean 600 should hold, though. I think it means 585 should hold. So if we decide bearish this afternoon and into tomorrow morning, I start looking for short-term downside towards 585. So it's a very inflection point-based trade here. Down 15 to 20 or up 15 to 20. The market's pricing in something like $10 into the end of the year. So I think that this is a little bit underpriced given the potential for the move. That's why the VIX is coming up. So effectively, the market is saying into the end of the year, we should be somewhere between 612 and 594. Well, 594 doesn't have a lot of logic to me. It's just kind of in the middle of this range. 612 doesn't have a lot of logic to me. And I don't know that I don't know that I can justify saying that we're going to stay in this tight range between 600 and 609. I'm thinking that the market, generally speaking, is just accepting the fact that we're probably either going to break out to new highs or fall back to 585. Thus, some general option buyers preparing their portfolio just in case. And I don't think that's a bad decision point. Once we get through this and we start to get a more directional clarity, then we can start to have that bigger potential for a VIX drop as people start to say, I don't need the hedge anymore for the next couple of weeks at least. Pitch the puts, sell out, put credit spreads, downside looks limited, et cetera, et cetera. So people like to sell options instead of just outright buy them because there is a cost to buying that insurance, and that generally keeps the VIX drifting lower when we've got a bull market. People don't want to pay for insurance. They want to generate income by selling out of the money calls. And those are just not that expensive right now. So given everything that we're seeing in the market, everything seems pretty much in line with normal expectations for this kind of market behavior and the timing. When we go to tech had been a bit of an outperformer on the back of stocks like Apple and Tesla. Again, I got two inputs this afternoon for tech that could be particularly meaningful between the Fed and then Micron earnings. Micron has had a nice run here. SMH on the whole has been trying to catch up to the tech move. It's been lagging tech on the whole. NVIDIA has been particularly weak. Tried a little bit of a mini breakout here with a target towards 262, pulled back yesterday. pushing back against those highs today. So for me, Micron seems to be the biggest potential input for that, since it's a semiconductor specific name. AVGO had very good earnings, as we remember from last week, that just spiked. It got a little bit more interest in the semiconductor sector. But NVIDIA, as mentioned, has been weak, and today is getting a little bit of buying. So all things pointing towards maybe setting up a little bit of normalcy, getting semiconductors back into a bit of a leadership condition. I'm happy to see that NVIDIA didn't liquidate yet. The good bounce back here is very, very affirming for the bull. It helps a lot for the tech market. It helps a lot for the broad market. It's been just such a big portion of this one, get this bounce back and potential continuation to the upside. It's a very, very resistance-oriented trade here. So I'm not looking for NVIDIA to jump to 150 and push. On the bull side, it'd be very much a call debit spread kind of trade, especially with the implied volatility rising back up here towards 48%. This 34 was frankly just kind of crazy to see it that low, but we'll see if this 48 level continues to hold. If we continue to rally, I do expect to see it drift down, because there should be some resistance above market right around here. One moment, make sure that I'm not getting anything too important here in the email. Micron, as I mentioned, has been bullish leading into earnings. It's actually very similar to what we saw last earnings, where we got the dip, and then the 3 days leading up to earnings, we went a little bit up the stairs. Today, we went up a little bit more aggressively, particularly on Monday. Monday was a nice bullish day. Yesterday, that little pullback. Today, follow through, preparing for that potential bigger upside move that, unfortunately for Micron, just kind of washed out afterwards. We towed near 115, drifted back to 100, back to 115, back to 100, back to 115, down to 96, then 105. So these like $10, $15 ranges, and now pushing towards the high end of that. We do have earnings this afternoon. The market's pricing in a big move. So normally the market prices in around 6%. Recently, we've seen closer to 10% on average. This time we're pricing in 12%, more in line with last earnings and the earnings in March of 2024 than the earnings we saw in December or June. This seems a bit aggressive to me to bet for 12%. 12% would push us back down just below 100. It looks like the real support should be around 97, 95 range, call it. The upside resistance doesn't have a lot of clarity to it, maybe up to 130. But that's a big move for earnings in Micron. I don't want to bet for 130. I don't want to bet for below 95. If I'm going to look for something in Micron, and I'm still leaning towards no, not this time. Last time I went for the 110 move. This time I think I'm going to hold off. But if I was looking for something, this $100 strike has good open interest, but not a lot of technical support. 95 has good open interest and technical support. That's too far for me to bet on the downside. On the upside, 120 or 125. Really, 125 is the big magnet, but slightly bullish earnings. 120 makes some sense. I think 125 would be the most logical landing point, having already seen a pre-earnings rally of $8. I'm not sure I want to bet for another 14. So given that we're looking at like 125 and 95, it would be a small trade if going for it, it's a little bit less clear to me that those are going to be the target points. But you can see that the put fly is about 50 cents. The call fly for 125 is about, let's see, 4.5, 635. So 185 credit, about 40 cents. So it's 90 cents for the double fly. Max value is $5. It's trading at about 18% of the max value. So it's in the right price point. It's just less evident to me on the target strike point that is going to be the case. I mean, we've basically done a pre-rally getting ready for this earnings, and that may reduce the total magnitude of the upside move. Or, and this is what gives me pause, or we could do it what Broadcom did and just have an outsized, ridiculous move to the upside that was about 3 to 4 standard deviations of the normal move and 3 to 4 standard deviations of the priced in move. I don't like betting on 4 standard deviation moves, 3 standard deviation moves. We had a little rally in AVGO prior to that big move. The market just had it right. Maybe, just maybe, we do something like that in Micron, but that dispersion of potential returns makes that a tougher bet for me. Lennar could be a little bit more interesting. So the market's pricing in that bearish scenario. We've seen it 5 earnings in a row. Lennar has been going bearish. We've recently been 5 to 7-ish%. So currently pricing in, now it's not showing the number we're pricing in, but we're pricing in around that normal average 5% downside. And with this fall off here over the last week and a half, I don't know that I would bet for much more than that 5%. So 145 to the downside looks about right, especially when I look at like the lows of July, just testing those lows, not necessarily pushing through. On the upside, there may be more potential here. There is less resistance to the upside naturally up until we get to 165 to 170 range. Now, 165 to 170 would be about 9, 10, 12%. That is a big move for Lennar. Nonetheless, I don't see as clear of a magnet on the upside as I do on the downside, even when I look at the options. So 145, decent size open interest. 140, I think is a bit too low. I can target 145 on the downside. On the upside, it's very distributed here between 160, 162.5, 165, 170, 172.5, a wide dispersion here. This is not a double fly scenario to me. I think that the fly makes some sense on the put side towards 145 and on the upside looking for a call spread. That's going to have a long delta to it naturally. If I were to go for like say a 155, 160 call spread, that's long 14 delta. Targeting 145 on the downside with like a 148, 145, 142 put fly, that's going to have a 57 minus 4, 56, like a very small, like 2 delta on the put side. So the long bias contrarian view has some justification here, but I would have at least 2 to 1 on a ratio here, doing 2 put flies to 1 call spread as opposed to doing a put fly with a call fly. Looking for, if we come in bullish, a move to at least 160, maybe higher. 160 is that first low here that we found buyers. I do think that if we come in bullish, we're looking for 165. So I could go for 160, 165 on the call spread. But that really does, like I said, require a big upside surprise here in the earnings. Effectively, though, can a small bullish earnings be enough to spark some short covering from traders and investors that are basically piling in saying this is a dead company? I think there's a decent possibility of that. So looking for this on the earnings basis, I think that we're looking towards that upside as the potential outlier move. The downside seems pretty well defined to 145 range with an outside chance of 140. And given that, I think the put fly with a call spread makes more sense. Before I go into tomorrow morning's earnings, I forgot to talk about small caps. So small caps, inside day so far, yesterday's high was 233.44. Today is 233.04. While I would love to see some further bounce back before going into small caps, again, I think they got to wait for the Fed to give me that justification. And that may finally get some buying back into financials. It may show some good support for home builders if interest rates start to shift. Home builders are testing a very big level here. We are below we're right at the October 9th, just below the October 29th low. Key support there, sitting right above the 200-day moving average. We haven't seen a bottom yet. A lot of red bars here. Yes, that means that if people say, I'm going to start saying after the interest rate shifts this afternoon that home builders are bullish, we've got some good upside. I think I'd rather wait though. So look for the home builders, in my opinion, post-Fed. Could look at KB Homes, which has just been an absolute dog. Could look at Pulte, which has been another absolute dog. These are stocks that have that potential for a bigger shift to the upside. Maybe we repeat sort of this behavior where we looked really bad, consolidated for a little bit. I don't know that we have enough time for consolidation, but we start to spike in July off of this low and on July 2nd. If the interest rate and the term structure of interest rates shifts significantly and people want to go that route, it's something to have on a watch list. And if it's bearish, frankly, I just ignore it. So I'm looking for a bullish sign here to give me a market bottom. Otherwise, that drift lower may continue. I'm not sure I see enough downside here to justify any real major trade there in the options. So the leverage, certainly to the upside, getting that reversal, then looking for, maybe 10% in Pulte Homes, and that could be a nice return on my portfolio. Let me do the Bitcoin names before I go to and the aggressive power trader names, and then I'll go back to tomorrow morning's earnings because we got a bunch of them tomorrow morning that could be somewhat interesting. Not big names relative to the mega tech, but they're still interesting nonetheless. Marathon consolidating, Riot consolidating near highs. That had the Starboard investment, gives it a little bit of a backdrop of bullishness. BTDR had the big pullback, but still in a bullish trend. And of course, the biggest one for me is MSTR, and it's just not giving me any follow through. Maybe we need higher Bitcoin prices to get MSTR going again. As it currently stands, seems like the market's just getting tired of being in MSTR, and we're reducing there to reallocate to other, maybe safer names. This has been a wild ride. I want to see a higher high and a higher low, and really I need to see prices push through that like 440 range to get me excited about that spike potential, because that's what we're really trading for in MSTR, is the spike, not for the grind it out, consolidate, and see what happens. As the implied volatility falls, that could become a justifiable trade again, but right now the implied volatility is still on the high side. It's not crazy, but that's the exciting time for trading MSTR. The day trader, the intraday, capturing the ranges. MSTR is just not exciting to the market, and I got to think maybe that's the reason that we're seeing a little bit of a pullback here, is people moving from the exciting dynamic movement that we were having in MSTR and not finding it anymore. That's kind of my Bitcoin stuff. Yeah, let me pull up a lift for you. Consolidating near the consolidation range, right? So we had this range here that should be providing some support. We dropped right back to it after a really bullish earnings. Bullish earnings for me is a good starting point for looking on the bull side. Bearish earnings, I tend to lean away from the bull case unless we start to fill the gap. So we filled the gap to the downside, finish that off. I want the bull flag. So we're inside yesterday's range right now. The high of 14.15, today's high is only 14.13, 2 cents away, but that can be significant. If we get back towards 14 and a quarter, 14.30 range, I look for the potential for a long side. Right now, on the downside, it looks limited. It should have a lot of support here, as all of these buyers prior to earnings are still generally in the money, other than maybe the November 6th buyers. So we've got a lot of money that eroded for all of the buyers post earnings. They got out. If they're out and that's done, now we can start looking for that formation to start going up, but it's not quite there yet. Around 14 and a quarter, 14.30, I start looking for a move back to 16.85. It's good upside potential for 20%. Maybe into a simple call spread. I like the weekly so I can get a little more precise here on the target price. They're a little wide up at that high end, and they're a little cheap too. So maybe given how cheap these 17.5s are at only a dime, the answer really is back to looking for calls once we see some momentum. God, I wish they had the half strike here, because like a 14.5 strike would be right in my wheelhouse on the January 17th. If these tighten up a little bit, or if I can get mid-market execution, the January 24th weeklies, 14.5 strike calls look like about the right level, but I need about a 30-cent rally before I go that direction. Excuse me. A little bit of coffee to lubricate the vocal cords here. All right. So Lyft has not been exciting for people. I want to see that excitement before I go for it. As it currently stands, the pressure from Uber has clearly been there as well. Uber does have the bull flag, or not the bull flag, the bounce back today. Usually a bull flag is a bull case scenario. This may be setting up a bear flag where we're just bouncing back after a couple of weeks of weakness here. So this may be setting up a bear flag ultimately, but at the very least, Uber may help Lyft just off of correlation trading. If people are buying into Uber and push it back to a 65, Lyft may get dragged up by that. So we'll see on that, but the weakness in Uber hasn't been helping Lyft. Now maybe a little bit of a bounce back can. Lyft has been strong relative to Uber. So, it seems like right now the investment community views it as a better overall company to invest in, but I got to see that in the stock price to justify the entry. And Uber may be looking to turn up, or it may find some good resistance here in the 65.5 range. So can I capture that 5% and then reevaluate? Absolutely. I think that there's a good potential for that. And if it shows weakness and gets back below yesterday or today's low, yesterday's high, right in this range around 61, would be a sign that this is just a what we call a dead cat bounce, just small bounce and then back down. That bear flag setup with a target of 55 initially, but I'm not sure I could really bet aggressively that support would hold, because it was a pretty weak low. So we had some increase in volume down here, but not so much that it's a big support point. A lot of the volume came here on the earnings announcement. They bounced it back, but then the earnings after that, we had a little bit of weakness. So overall, 55 may be light support if it goes bearish, but from here, a little bit of bullish early signs, and that may help lift some. So we'll see if Lyft can be lifted by the market here too. Peloton. So for aggressive power trader, Peloton broke out yesterday to a new high, faded back just to the high of December 6th, which was 10.59. Yesterday's close was 10.57. Chopping around it a little bit today. General market confidence would likely lead this to a nice bull trend if we see buyers this afternoon that, shifting the tide to generally looking bull side helps drag up everything. And then that can trigger some technical levels for Peloton and others. Frankly, I like the chart overall being here near the highs. We'll start to get some of the information from the Fed before the market close. If I start seeing the market bullish, Peloton looks like a good entry point. And like I said, I do expect to see general bullishness for the market this afternoon. SPY is the other one that's been looking good. I mentioned it yesterday. We did add only one trade for paid this week, and it was in SPY. So in a bit cheaper here, already up about 5% on these SPY Jan 602 calls. We'll look for that to potentially really start to accelerate here into the end of the week and capture that Santa Claus rally, barring a Fed surprise. So overall, we're seeing the short-term signals bullish on it, the medium-term signals bullish on it, and the seasonal impact bullish on SPY. So I do like SPY, but again, because we've got some Fed information coming out before the close, that can actually be captured by just trading late in the day, I think, for SPY. All right. All right, let's go back to tomorrow morning's earnings. And like I said, if you got other stocks, throw them out there. Accenture. So Accenture is about a 5% mover. It's priced in at 5%. 5% is about 17.5 bucks. So call it between 335 and 340. This support looks like it should exist closer to 341. So 4% move. 335 to 340 is a little bit lower level support. I don't see a ton of open interest here in general in Accenture. I think this is just a pass. The big open interest is up at 390. That's too big of a move for me to go for in earnings. So I'm not looking for Accenture. Cintas, normally about a 5% mover. Pricing in, we've got some missing data here on 3 of the earnings showing 0% expectation. So that implied move is completely off there. Disregard that. Just looking at the realized move, normally 5%, this time pricing in 6%. So again, pricing in the move. 195 would be roughly the target on the downside, 220 on the upside. Maybe we have a little bit less downside because we already had this big drop on December 9th, and 200 level can hold. That's where the open interest is here, is at 200. On the upside, 220 is the open interest, or 230. 230 is more aggressive than I'd like to be in this, 10%. We haven't seen 10% in the last 2 years. We haven't seen 10% in the last 5 years. That seems over ambitious. 220 looks like a better target range for me. And so maybe this is just, instead of being purely symmetrical, looking for 195 and 220, utilizing that increased open interest here at 200 and looking at 220 on the upside would be a potential for the double fly. We've got to see these markets tighten up a little bit more. I mean, being $1 wide on a $3.50 option is too wide. So the liquidity could be a concern for Cintas, but overall, $5 wide spreads, 205, 200, 195, and 215, 220, 225 could be an interesting target zone there. But I want better liquidity. Darden, more interesting to me. So on the earnings, I don't want to look at 5 years. We had one outlier there. On the last 2 years, we've averaged expectations around 4%, averaged moves around 2.5%, but the last couple earnings, we've seen some bigger moves. I wouldn't necessarily bet against a 6% move here, and the market's pricing in 5%. The strikes line up pretty well for 155, which is really the firm support here. 175, which is really that firm previous high resistance. This lines up pretty well overall. The 155 strike is definitely big open interest here. The 175 strike is small open interest, but it's about all we've got on the call side. Most of the open interest here has been driven by the puts, this big 170, 155 put spread. 155 could definitely be a magnet off of the December options. Open interest. January, it's a little bit more spread out and further away, 145 on the downside, 180 on the upside. But I'm looking for that $10 kind of move here in Darden. And I think that this one is one of the better setups for tomorrow morning, just because of the technical formation here, setting up 155, 175, basically capturing the last 3 months range as my target. We oftentimes see a move where we go right back to that upside or right back to that downside. And since we're not trading at the highs already and then looking to spike out of the range, going for the natural resistance point or the natural support point seems like a logical trade there. So Darden could be one of the more interesting ones, as I said, for this afternoon. A 160, 155, 150 put fly is trading around 55 cents. A 170, 175, 180 call fly is trading for around 40 cents. So it's got decent leverage there. Call it under $1 for the double fly that maxes value at $5. Doing it on a Wednesday has often been some of my favorite, Wednesday afternoon, so that I only have 2 days of consolidation to worry about and allow that premium to erode once we hit the strike. It is still either going to work and maybe triple or quadruple my money, or not work and I lose it all. So I have to keep that in mind. I need to have at least a 30-35% chance of success for this to work. But I think that this is setting up for a 30 to 35, maybe 40% chance of success. So DRI is an attractive potential double fly for me, as long as the execution is reasonable here, given that some of the strikes, for whatever reason, the 180s are wide. These should tighten up and I should be able to get decent execution. With the 175s actually being a little cheaper than the mid-market here of 105, it's probably closer to $1. As you see that implied volatility at 83%, it's probably a little bit lower than that, but you get the idea here. The DRI, the targets look pretty well in line as long as I can get there. Got 2 left to look at on earnings, and then I'll pull up RGTI for you, William. So CarMax had the big pullback yesterday after a really nice bullish run here to retest highs and fade. Tested a breakout and then fade. Their earnings normally move around 7%. We're pricing that in roughly. You'd be looking for something above 75, maybe in the 76 range. On the upside, it would be a new high. The options, we have $2.50 white strikes and almost no open interest. So this one looks more like a pass to me at this point, unfortunately. Maybe there's a trade afterwards. And paychecks, you know, it's an interesting industry, and we do have some, we're really testing support here, and the next level of support should be around the 133 range. Earnings-wise, we normally move 4 to 5%. 5% is $7. That puts us at 133. So 133 on the downside, 147 on the upside. The high from November looks like a logical range. Unfortunately, we have $5 white strikes instead of 2.5. We have no open interest really, other than right at the money here. On the upside, we do have some open interest at 150. So kind of in the optimistic, maybe looking for that $10 move of targeting 150 and 130. We have to get into the range. So if we hit 133, the put fly can appreciate enough to make it work. On the call side, there's resistance between 147 and up to 150 on the high side. So the bull case, I think, is a better odds of paying off. But that doesn't mean that the bear side can't hedge that risk nicely if we do drop to 133, 132.5 range, or even a little further, get lucky and move to 130. So from the earnings plays, I think PAX, Darden, and Lennar look the most intriguing to me. As much as I would like to make Micron a trade, I just don't see it. Others may see something there, and if so, more power to you. RGTI, another elevator. What are they? Quantum computing. Okay. Should have guessed, right? So quantum computing, elevator up. Last time we touched this 90 RSI. Started to fade a little bit for the next leg higher. Well, for now, I think I would just treat this the way that you got to treat the elevators. Is the volume is still there. There was a concerning day really on the 12th as we had limited volume, but we didn't push below the lows. I mean, the bull side is definitely the leverage side. At some point, this elevator up likely stops and we drop back down towards 9. Maybe further if we get really low interest in quantum computing again. But, you know, quantum computing is all the rage right now. People love it. You know, I think it's just right now where we're at. Long is clearly in control. We start getting below yesterday's high, and that starts to give the short a little bit of potential confidence that we've topped out from this move from being a dollar stock to a $12 stock, a 10x kind of return over the last few weeks, month. I always like to tread lightly in these kind of names. I don't trade a lot of these day trade, intraday scalping kind of trades, but as long as we stay above yesterday's high, I think the bull remains in control. And seeing some of this buying action here on the open is a positive first step with some decent volume for the first two 15-minute bars. Yesterday was light volume on the open and then just kind of consolidated. But even on like Monday, we had light volume on the open and then found kind of one buyer that pushed us up before pulling back. The higher volume here on the open does give a little bit of sign for the bullish trader though. So as long as that volume continues, I'd look for the upside. If the volume starts to wane and we drift lower with no volume, it means we've found the end of the buyers. And that's what the market's trying to find right now. It's when do the buyers stop? So volume dropping indicates the buyers have stopped being aggressive here. And volume and price dropping starts to say, well, people are looking maybe to buy the dip, but a lot of times when you see these elevators up, people don't actually buy the dip. They say they want to buy the dip, and then when we start to fall, they don't buy the dip. So I'd be very concerned if we started to see a low volume drop. But as long as we're seeing this volume here, like we saw in the open, the bull is in control. But very much obviously a stock trade. I'm not sure if the options can really, 230% implied volatility, expecting a daily move of 15-ish%. It's a pretty aggressive options market, implied volatility. We've been realizing it, but at some point that starts to fall off like we saw in like MSTR. So just waiting to see when the party's over. Right now, the party is still loading up. But now that we're starting to drift back down towards these highs at 1120, that's ultimately would be my concern level. So 60 cents downside. And then as I get in, just trailing stop. If I were to buy into this, it would be all about the trailing stop. So yeah, keep that risk defined. WMB. I was talking about yesterday on the close. We stopped finding the selling volume. And then this morning, slightly weak, but on very little volume. So if you look back over the last few weeks here, we had Monday sellers with heavy volume, Monday sellers with pretty decent volume, Monday sellers with good enough volume. This week, Monday, very light movement. Yesterday, we bounced back into the range. I'm not seeing any aggressive sellers here. It's just now looking for the buyer. So I think WMB has some good potential to the upside. Now that it looks like the main selling pressure is gone, it's just now we've got to wait for that buyer to come in and start pressing these higher. Same idea with One Oak. Looking for the next buyer now that we've seemingly run out of aggressive sellers. So it was the same sort of pattern here. Monday seller, Monday seller, Monday seller. Monday limited selling, but we haven't gotten the bounce back yet. So the value investor has to start getting interested in these again. But when it happens, I want to be ready to jump, knowing that this could push back to the $58 range. I like using an out of the money call in this scenario and looking for that $58 trade. January 55s is my target range there. It's just not quite there yet. I thought yesterday might be the sign that we're getting that bottoming action. But today, not seeing the confirmation of it yet. I got to see the higher high. So above yesterday's high, I start getting more interested in WMB. That's been one on my list here to watch the last few days. I got to see what we do. So it was a trade that I liked last week for an exit on Friday, and now looking to engage here on a sign of bottoming action being confirmed, which again, not quite there yet. When I look at the mega caps, by the way, Apple consolidating near the highs, kind of holding up to prevent the market from collapsing. Tesla consolidating near the highs, holding up to prevent the market from collapsing. You see tech unchanged, and it's on the back of the big boys, not on the back of the of breadth. Microsoft starting off a little bit weak, bouncing back. We're still seeing investment flow into some of these mega caps to hold the market in place. Clearly a safety trade. People just looking for the safest bets they can in the market while they wait for the next announcement. One that I wanted to note here was AMD. So if those semiconductors can start to lead, now that AMD has wrapped up a lot of its bearish action and retested lows here, now I start to look for this to turn and push back towards 140, 145. Not looking for like 175, October high levels, pre-earnings high levels. I'm looking for a move back to this range here we saw at the end of November. We liquidated it. We pushed it down to lows as semiconductors fell out of favor. We're an inside day today. We're not seeing a follow through on the selling side. We had some good volume sellers, particularly on the 13th on Friday. Want to watch this one carefully for a potential bounce back trade. Okay. So AMD is one that I am looking at as a potential for a call spread. Very simply, like a 130, 140 call spread for January. Once we see a little bit more bullishness, should be trading under $3 still. And if we do get the bounce back, 138 looks like 137 to 138 looks like a low bar to achieve. And that should give that at least a double. And if we get the full follow through, I could triple my money on that trade. So bounce back in AMD could be interesting if semiconductors get some more money flow. No more on the bearish side on AMD for me. Some of the previous bears that have actually been rallying, Etsy. So this looked pretty bearish, had a bounce back on earnings, started looking like it was going to liquidate. Now following through, starting to reject some higher prices. So if Etsy can get below this 57.5 range, that starts to set up on the bear side. And I just generally don't like Etsy, and that's my fundamental bias, not based upon the fundamentals of the company. Just I don't think that I don't see a lot of value in the way that the company operates. I might be completely wrong. I just tend to think I'm biased bearish on like Etsy or Pinterest. And again, these are names that are getting close to those inflection points. If we get below the 2970 range in Pinterest, I start to think about pushing that to a new low. Outright puts, generally speaking, when I'm going bearish, because implied volatility tends to rise in the bear case. What else was I looking at on the potentially weak side? Let me look back. Ooh, bigger move today in Kraft Heinz. So this is a good example of that bearishness bounce back, retest, bounce back, and now pushing through to new lows in Kraft Heinz. If we can't close above 30.5, which is where we're at right now, Kraft Heinz looks ready to set the next, trending down lower. Why would I buy? And if I'm long, why would I keep it? Everybody that's bought Kraft Heinz over the last 6 months and held it is losing money. So looking for that capitulation selling in Kraft Heinz, and I haven't seen capitulation selling here. It's been a more aggressive but timeline-based selling here. We haven't seen a major volume spike with that big crash to show a real bottoming action as we get to these new lows. And that could set up for another leg lower here over time. Potentially kind of aggro on earnings tomorrow. I'm not looking at doing anything pre-earnings, but post-earnings. Last earnings, we had the big collapse. If it gets bearish on earnings again, I'm not looking to bet for it to consolidate after a bearish earnings. 2 bad ones in a row could get some follow through. So something just to watch for tomorrow for like a put vertical post-earnings to push down. Last time we went from 30 down to 29. If we go to say 26 on earnings, 25, 24 would be an interesting target zone with implied volatility dropping after the fact. Yeah. So Fred, that's what I'm thinking about with that AMD is definitely that Jan 130, 140 call spread. I still think I want to wait till after the Fed only because I'm already long biased in my portfolio. So I'm doing what the market is doing. Got to have some longs out there, but I don't want to be all in until I see the news. And then I want to be aggressively quick on that move once I see the Fed reaction. If we fade on the Fed reaction, I don't want to be experiencing a big loss that makes me feel like I can't buy at all or that I can't move. If we start to see profits, then I want to buy that momentum to the upside before we fully achieve that 615, 620 level in SPY. But AMD is definitely an interesting one for me, given the overall setup in this market. We shall see. And I got to give a little preview on this. I'll talk about it more tomorrow and the closing bell, but we've got FedEx tomorrow after the close. We had a nice rally, then we had a big pullback from 305 back down to 275. I don't know which way earnings are going to go. I lean bullish on FedEx in general. I think that's good, with a good sign of a strong economy when the shipping companies are doing well. Last time we had a big bear earning, we had the sort of traditional size bounce back. 10% would put us right back to the highs. So 10% from here is $28, puts us right back to 305, 306. I think this one's definitely setting up interestingly for an earnings play. 25 to the upside puts us at, like I said, that 305 range. 25 to the downside, retesting the lows. A very nice spot to be trading from for the earnings. Good open interest at 300. 255, really 260 has bigger open interest, but I kind of think that this has that shot for 305. I just want to widen it out a little bit in case we stall at 300, because this is only a one-day trade. So if I do this tomorrow, I only have Friday. So I have to hit my price that day. It's very much a binary event. It either does what I want or it doesn't. I have like I said, a lightly bullish lean here. One possibility in order to finance that bullish bias is to just sell puts for like a 250, 245 for $1 and then buy the call fly. Or I do the double fly, targeting 255 and then targeting 305 on the upside. So we'll see. I'll reevaluate it again tomorrow to decide how to do it. But I actually think FedEx is one that I want to make sure to have something on, because I think that one has a good chance of being interesting. And if we rally to 290 tomorrow pre-earnings, my bias may disappear on that. But as we know, like the pre-earnings move doesn't necessarily mean anything. I mean, you look at this last pre-earnings move, rallied right into it and then collapsed. So this time selling off into it really doesn't mean anything. The market doesn't necessarily have it right. Yes, Fred. Up 10% so far. It's all on paper until the Fed makes their announcement, though, right? So not looking to exit today. Up about 10% so far. We shall see. I'm optimistic. Having a 10% positive cushion is better than a 10% drawdown leading into the Fed. But at the end of the day, the market will tell us this afternoon whether right or wrong. So the 10% is 10%. It feels better than being, like I said, down 10% and hoping for a recovery on the Fed. Now I can say at least I've got a starting point of feeling good about it. And I mean, ideally, if we can get 35, 40% on that, is a decent target range for a good return. With the Fed announcement, it could be a bigger return because there's a little bit higher risk of a bigger drawdown. So I think if wrong, it could be a 30 to 40% loss because we have an event. But if right, there could be a 100% return because of an event. So we'll see what the market gives us, though. All right, we are bumping up against time. Any other last few ideas you guys want to look at before we call it and start waiting on the Fed? I mean, it's hard to read too much into the technicals of today, knowing an event is coming. It's like trying to say that I can predict Micron's move based upon technicals, knowing a fundamental input is coming. It's not going to happen. It's a little bit easier with the overall broad market and the indices because they are not solely dependent upon one Fed data point. But nonetheless, I've got to be aware and cautious about that heading up. Is XLF starting to bounce back here? See Morgan Stanley firm. Yeah. That could be a good indication that people are starting to predict what the Fed announcement could do for financials as well. TLT, somewhat on the weak side. So interest rates definitely. What's TNX up to right now? TNX sitting at, kind of unchanged here near the highs. Yeah, nothing major shift there yet. We will see what happens. I think gold and silver, by the way, could be movers post-Fed. With the way that the dollar has been moving, testing these highs here, I gotta think gold and silver should be lower. Gold in particular, silver's already there, right? So silver's already on that low side. Gold should probably be lower, but this may be kind of paired off as another risk scenario for people if they start to hear the word inflation being a problem. Then people like to think about commodities as an inflationary hedge, but Fed action can completely unwind that hedge element. So you got to keep an eye on it, but I lean bearish still in gold, thinking 237, 236 could be a target if, depending a little bit upon the reaction to the Fed's announcement. If people want to go back into stocks, they may start to abandon the precious metals again. And then they go for their real inflation hedge, which is Bitcoin, right? So, all right. We will call it there for today. Oh, no, I had one more. I wanted to just note Expedia upgraded at Bank of America today. So had the bullish behavior, little pullback, got the upgrade today. I like watching this one. This could be an interesting upside play here. So that upgrade gets it back really close to the highs, helps unwind some of that selling pressure. As long as the performance stays up here today, Expedia looks good for an upside call spread. So I'd be looking for the breakout with a call spread, targeting that 200 level, just a big round number, 190, 200, very similar leverage to that AMD concept. So call it 270 right now for the call spread. And if we just grind out towards $200 a share, it starts to look pretty good, but the resistance should be around 192.5. So roughly where that intrinsic value kicks in for a currently $2.5 to $3 call spread. So one other one to watch here for today. Again, I think we've got to be a little bit very flexible and a little bit timid until I get confirmation on the fundamentals being out of the way and letting the technicals and the seasonality drive the market again. All right, folks, I will see you tomorrow for the closing bell. Good luck with your trades today, and let's hope for the Fed to be kind to the market as they normally are. Have a good one, guys.